All right, so you're thinking about diving into the world of swing trading. It's kind of like, catching a wave buy low, ride that stock's momentum for a few days or weeks even, and then sell high. Sounds simple enough, right?
Well, yeah, in theory it does.
But is it really that easy? Well, today we're doing a deep dive into an excerpt from Introduction to Swing Trading to, uncover those need-to-know basics and help you figure out if it's the right strategy, for you.
You're right. The basic idea is simple,
Mm-hmm.
but of course there's a bit more to it than that. Like most investors, they get so caught up in the daily ups and downs or focus on the really long-term trends.
Right, right.
Swing trading is all about finding those sweet spots in between, the shorter-term market movements that most people just miss.
Exactly. It's about finding the rhythm of the market. Yeah, not getting too caught up in all the noise. So let's break down the fundamentals of swing trading based on what we learned from the excerpt. What are the key things that someone who is totally new to this needs to understand?
Hmm. Well, first off, you're not aiming to buy at the absolute bottom and then sell at the very peak.
Yep. Yeah.
Swing trading is about recognizing a trend. You ride it for as long as it lasts, and then you get out when that momentum shifts.
Hmm.
It's a more active approach than, say, passive investing, but it's less intense than day trading.
Okay, so you're not glued to your screen all day long like a day trader. Got it. But how do you actually pick the right stocks for this kind of strategy? The excerpt mentioned something about liquidity and volatility being key factors.
Absolutely.
Yeah.
Liquidity is essential because it means you can easily buy and sell your stocks without, dramatically affecting the price.
Right.
Think of it like this. It's much easier to buy or sell, like a popular video game, than a rare comic book, right?
Yeah. Yeah.
You want to be able to get in and out of your trades smoothly.
So you're saying it's about being able to cash in those games quickly when you hit that sweet spot.
Yes.
Okay, that makes a lot of sense. But what about volatility? Isn't that a risky thing?
Well, volatility is actually what creates the price swings that swing traders capitalize on.
Yeah. Yeah.
Imagine like a swing set, you wouldn't get very far if it barely moved, right?
Yeah.
You want that exciting back and forth motion to gain momentum.
Yeah.
Volatility provides those opportunities to buy low and sell high.
That's a great analogy. More movement, more potential to make moves. And speaking of movement, the excerpt mentioned large cap stocks being good candidates for swing trading. What's the deal with those?
So large cap stocks are from, well-established companies,
Mhm.
and they're traded very frequently.
Mhm.
That means they have the liquidity we were just talking about. They're always buyers and sellers, so it's easier to get in and out of positions.
They're like the reliable swing sets in the stock market playground,
Yes,
right?
exactly.
But here's something I've always wondered. Doesn't the overall market situation matter? I mean, swing trading during a bull market versus a bear market has got to be a different ball game, right?
You are absolutely right. The overall market trend plays a huge role in shaping swing trading strategies. The excerpt talked about three main market conditions:
Yeah.
bull, bear, and what they call in-between.
Okay.
Each requires a different approach.
Okay, so let's unpack these different market scenarios. Let's start with the bear market. When the overall market is going down, it seems like you'd need nerves of steel to swing trade under those conditions.
Yeah, it definitely requires a more cautious approach. When the tide is going out, you have to be very strategic about which waves you try to ride.
Right.
The excerpt suggested, shortening your trade periods in a bear market.
Okay.
Don't hold on to stocks for as long because that overall downward trend is working against you.
So instead of riding a long, lazy swing, it's more like quick bursts on a seesaw. Get in, get out.
Exactly. And holding more cash is crucial during a bear market. It's like having a safety net in case, a trade goes against you. You're also not limited to, simply buying stocks and hoping that they go up. The excerpt even mentioned using options, specifically something called buying puts.
Hmm. Options. I've heard of them, but they've always seemed a bit mysterious to me. Could you explain those a little more, especially, in the context of a bear market?
Sure. Think of buying a put option like buying an insurance policy against your stock going down.
Okay.
If the stock price falls, the put option increases in value, which helps to offset your losses. It's a way to potentially profit from a declining market or, at least protect your investments.
Okay, so it's a way to hedge your bets in a bearish market. That's really interesting. But for now, let's move on to, calmer waters. What about swing trading in a bull market? That's
Yeah,
going to be paradise, right?
Well, it might seem that way,
Mm-hmm.
but Even in a bull market, you can't just, swing blindly.
Right.
Remember, not every stock goes up just because the overall market is doing well.
Right.
You still need to choose your trades carefully.
And that's where those bad habits can form, right? Like the excerpt was saying, getting overconfident and forgetting about risk management.
Exactly. The bull market can, lull traders into a false sense of security.
Yeah.
They might get caught up in the hype, ignore their strategies, and then, suddenly the market corrects and they're left holding the bag.
Ouch.
Even in paradise, you need a plan.
So even when the waves are looking good, you gotta surf smart. Now let's talk about what the excerpt called in-between market conditions. It sounds like this is where the real swing trading magic might happen.
Yeah, these periods where the market isn't, strongly trending up or down can offer excellent opportunities for swing traders.
Okay.
They tend to be more volatile, which means, more price swings to potentially capitalize on. But there's less risk of getting caught in a sudden reversal, like you might see in a raging bull market.
It's like finding that perfect balance between excitement and control.
Exactly.
Okay, we've talked about picking stocks and understanding different market conditions, but how do we actually know when to make a move? That's where the technical analysis part comes in, right?
Yes, and the excerpt mentioned a tool called the exponential moving average, or EMA, which can be really helpful for swing traders.
Okay, full disclosure, I've always been a bit intimidated by EMAs. They sound really complicated. Could you break them down for us?
Absolutely. An EMA is basically a line on a chart that shows you the average price of a stock over a certain period, but it gives more weight to recent price data.
Okay.
This makes it more sensitive to changes in price compared to a simple moving average.
So it's like a trend line, but smarter and faster.
Exactly. It helps you see the direction a stock is moving in a more responsive way.
Gotcha.
Swing traders often use multiple EMAs together. The excerpt mentioned using the 9-day, 13-day, and 50-day EMAs as a popular combination.
Okay, that makes sense. But how do those three EMAs actually work together to guide your swing trading decisions? What am I looking for?
You're looking for what we call crossovers. For example,
Mm.
if the 9-day EMA crosses above the 13-day EMA and the 13 days above the 50-day, that's a bullish signal, suggesting the stock is gaining upward momentum and might be a good time to, consider buying.
And on the flip side, if the 9-day dips below the 13-day and the 13 days below the 50-day, that's our cue to maybe think about selling.
Exactly. It's like those EMAs are whispering little secrets about, which way the stock might swing next.
This is making a lot more sense now. I can see how EMAs can be really useful for spotting those potential entry and exit points. So we can use those EMAs to try and get ahead of the curve, see which way the swing is going. But then there's that big question of when to actually sell. Timing has got to be everything in swing trading.
Yeah. Your timing is important, but it's not about, trying to perfectly call the top or bottom of a pro swing.
Right.
Even the most experienced traders will tell you that's nearly impossible. Swing trading is more about managing your risk and letting your profits run.
So instead of trying to time the market perfectly, what should we be focusing on?
The excerpt mentioned using something called channel lines, which I find incredibly helpful.
Okay.
You essentially draw lines connecting the recent highs and lows of a stock's price on a chart. It creates a channel that the stock is trading within.
So it's like setting boundaries for the swing.
Exactly.
Yeah.
In a strong uptrend, you might wait until the stock's price gets close to the upper channel line before selling.
Mm-hmm.
But, if the market's a little shakier, you might consider selling sooner, perhaps even before it hits that upper line.
Mm-hmm.
It's all about adapting to the market conditions and managing your risk.
So channel lines can help us visualize when a stock is, getting ahead of itself or starting to lose steam. I like that.
Exactly.
They're like those safety nets they have at the trapeze school, just in case.
Exactly. They give you a framework to work within. And speaking of frameworks, it's important to remember that swing trading isn't just about, technical analysis.
Right.
The psychological aspect is huge.
Oh, tell me about it. I remember getting caught up in the hype of a tech stock a while back, ignored all the warning signs because I was so sure it was going to the moon.
Mm.
Let's just say I learned a valuable and expensive lesson about letting emotions get in the way.
We've all been there. We've all been there. It's so easy to, get emotionally attached to a trade, especially when it's, doing well.
Yeah.
But successful swing trading requires discipline. You have to be able to stick to your plan and not let fear or greed cloud your judgment.
Discipline and keeping a cool head. Solid advice for trading and for life in general, I think.
Well, this has been a fantastic deep dive into swing trading. I feel like we've gone from, the basic definition to actually understanding some of the tools and strategies involved. And remember, this is just, the tip of the iceberg. Swing trading, like any trading strategy, takes time and practice to master. There's always more to learn and refine.
So for our listeners out there who are, feeling energized and ready to start exploring the world of swing trading, what's one key takeaway, one thought-provoking question they should be asking themselves?
Hmm. I'd say don't be afraid to start small and learn as you go.
Hmm.
Paper trading, where you simulate trades without risking real money, can be a great way to practice. And remember, every trade, whether it's a win or a loss, is a learning opportunity. Pay attention, analyze your decisions, and never stop learning.
Words to trade by. That's all the time we have for today's deep dive. Until next time, happy trading, everyone.